And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal. The full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning and welcome to the Hump Day edition of The Real Investment Show. And today we're going to be talking basically whatever your questions are. So we're going to try something a little different today on the show and basically ask, let you in chat. If you're on our YouTube channel right now, in our chat, you can ask questions. We'll talk about that. If you don't have questions, we'll talk about something else. So, but we'll try a little something different today. Danny's out today, so I thought we'd take the opportunity to have a little conversation with you directly. Headlines out this morning, not a lot going on. One of the interesting things, though, that is happening is that we have a record push in retail buying for equities. There was a couple of charts out this morning. I posted one on our X account showing this massive surge. We've seen retail investors have bought $100 billion of assets over the last month. It's a record. And last time we kind of saw that kind of surge was just post pre-Liberation Day. So when we had that Liberation Day sell-off, that big surge immediately kind of coming back, we saw that at that same time. But again, a very large increase in just this demand for equities. And it's very reminiscent of what we saw in 2020. And that's kind of the head scratcher a little bit in terms of, hey, I get 2020, 2021, right? We were sending checks to households. There was nothing else to do. You had nothing to spend money on. So people started throwing money into the markets and speculating. But they were getting money from the government to do that. So we don't have that now. We talk about these, kind of consumer indicators that are showing savings rates are dropping, consumer credit delinquencies are rising, yet money's flowing into the markets. Yes, a lot of that's coming from margin debt. We have a record level of margin debt right now. Margin debt as a percentage of the Russell 3000 market cap is rising sharply back to levels normally seen near market peaks. But again, that's just the function of the bull market. It's just absorbing money right now into the market. And that's keeping markets elevated. Having said that, though, yesterday did have a little bit of a down day. Nothing major this morning. Futures are pointing back up again this morning. So again, what happened yesterday is kind of a little blip in the pan. But we'll talk about a couple of those things in a second. But it is very interesting. A lot of speculative push right now, lots of bullish sentiment, nothing wrong with that. And of course, as we've talked about before, it's across all asset classes. We're seeing it in stocks, emerging markets, international markets, saw it in Bitcoin, record highs. Gold hit 4,000 yesterday. So everybody's very excited right now. Gold 4,000, nice big round number. S&P is going to hit 7,000, nice big round number. We'll get there probably by the end of the year. So again, markets love these big round numbers. They're big psychological things. They're like magnets, and they pull prices up to it. So we're seeing that and seeing this going on. Of course, that just feeds that bullish sentiment and drags more and more money into those asset classes. So again, we assign narratives around all this. Well, it's AI, it's government spending, it's the shutdown, whatever it is. We assign all these narratives, but at the end of the day, it's just simply speculation in the asset. It's people chasing the asset price higher, and that's fine. Bull markets can last for a very long time, but it is just a very interesting thing that we've got going on too, because we don't have that environment in 2020 of liquidity, yet we have liquidity coming in from every possible source that we can figure out. It's a very interesting dynamic in the markets, but very common to, bullish markets that kind of tend to lead towards melt-ups eventually. And that's going to be the subject of this weekend's newsletter, is the potential of a market melt-up and what we're seeing going on right now. All right, here's what you need to know before the bell this morning. Like I said, a little bit of an interesting day yesterday. Markets were down just a smidge. I haven't seen red on my screen here in a while, but we really saw it pick up yesterday in some of the small cap stocks in particular. So, those areas, those small cap stocks, as we noted before, if you go to simplevisor.com, we've launched some new portfolios there, some thematic portfolios back on August the 1st. Today is mid-October. And the small cap, mid cap index was up, or portfolio was up like 22% on the back of a lot of these small cap stocks just having huge days. Well, yesterday, while large caps were down just a smidge, small caps really took a pretty hard hit yesterday across the board. A lot of these big winners, we saw decent reversals in yesterday. Saw the same thing in Bitcoin. I got a couple of phone calls. It's like, hey, what's going on with Bitcoin? Bitcoin's down like 5% going on. There was really nothing going on. It was just Bitcoin had hit a record high here, and all of a sudden yesterday just saw some profit taking come into the markets, a little bit of risk off. Again, very overbought. We've kind of seen this before. One of the things that we kind of be paying attention to with Bitcoin right now, more than anything else, is that you're just building a series of tops here that is at least kind of worth paying attention to. We tried to break out of that previous double top here, but we're building this basing process. So this is either going to be bullish or bearish depending on how it breaks. If Bitcoin can break back above the top of this kind of consolidation band, then it's going to potentially make a push higher. But again, if it fails here and then takes out these lows, you're going to have a decent correction here at some point as well. So again, just kind of pay attention to that price pattern right now. But it was interesting yesterday, kind of some of these more nefarious kind of risk on, risk off assets saw fairly big downturns. Like I said, yesterday, like I said, Bitcoin, we saw that there. Small cap stocks, we saw it there. And again, just kind of moving across markets as we've been talking about the last few days, we're just, continue to see that kind of speculative push, kind of really overbought conditions across the board. And emerging markets as well had a decent sell-off yesterday. Again, it just, these aren't major, particularly when you're kind of looking at these longer term charts. It doesn't look like a whole lot, but we haven't seen that kind of a down day in emerging markets here for quite a while. It's been fairly muted, but yesterday we really kind of saw some selling come into some of these risk-off assets, or these kind of higher risk-on assets that we haven't seen in a while. So it'll be interesting to see if this is just a one-day blip, or if this is the start of something a little bit larger and worth paying attention to. And particularly when it comes to emerging markets and international markets and things that really kind of trade off that dollar, as we talked about yesterday, watch the dollar. It's actually having a fairly strong little run right now, up again today. But we're starting to break out of this consolidation that we've been in on the upside. That's going to potentially put pressure on kind of these other assets that trade off dollar weakness. Pay attention to that, because we are starting to see some strength here. Getting a little bit overbought here. Again, not suggesting that the dollar's just about to go ripping off, but kind of keep a watch on this. We've formed this very nice long base. We've got this kind of rising trend in the dollar now. So again, just as a risk measure, continue to pay very close attention to the dollar, because that has a lot of impacts on other areas of the market as well, particularly where the narrative is tied against an anti-type dollar trade. So just, again, worth paying attention to. That's what you need to know before the bell this morning. We'll come back. We'll start talking about your questions right here on The Real Investment Show. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
And now, another page from the Real Investment Advisor's Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back to the show this morning. Like I said, we'll talk a little bit about your questions and comments this morning. I thought it was interesting. We're running a poll on our YouTube channel right now. So again, if you're watching our show, we appreciate it. We stream on X, LinkedIn, Facebook, or Meta, whatever they call it these days. I'm just getting used to not saying Twitter anymore, right? So give me time. I'll get to the Meta thing. But we are streaming on all four channels. If you're in our YouTube chat, though, if you flip over to our YouTube channel and join our chat and have questions this morning, I'm happy to try to weed through all the comments. And again, if y'all can kind of just stay on topic this morning, that'd be helpful for me to try to read through and pick out your questions. We are running a quiz this morning, or a poll. And it's what's the number one thing on your mind right now about the markets, and the Fed's next rate move, inflation, the economy, stock market valuations. But the number one answer or response right now is how to invest right now. And that's the interesting thing is how do you invest right now? And it seems easy because you just buy anything because it's all going up. And that's an easy thing, right? Buy gold, is going up. Buy Bitcoin, is going up. Buy stocks, are going up. It's a fairly easy process. And as I was just talking about a second ago, and I can show you, just to kind of give you some context, I'll show you this chart that I just posted this morning on our X account, because again, this kind of just brings home more importantly about what's happening within the overall market. But this is the rolling 1 month estimated retail demand for stocks by retail investors. And, we just have currently just exceeded all previous records. And again, you kind of go back and you can see 2020 where there was this big drop off in retail demand because of the pandemic shutdown. And all of a sudden this massive surge directly back up. But that was the checks to households. And then you can almost pick out where checks hit households early 2021 and then moving into late 2021 and then moving into late 2022. You can see where we got checks hit to households, and then you got a lot of speculative demand started back in kind of October 2022 and then in late 2021. And then you had the big drop off in 2022 during the bear market. And then once the market bottomed in October of 2022, it's just been this gradual rise pulling retail investors back in. But this recent surge is quite phenomenal, just from the standpoint of retail investors kind of just chasing the markets right now. So again, where do you invest right now? Everywhere. So just buy something and it's going up, but that's the risk, right? And we were talking about this yesterday. This is my concern in this type of a market. And again, I've been in these type of markets before. I'm not just talking out my butt, but I've seen these markets before. I've been here before, and I know how these things end. Now, they can last a long time, right? And this is the big challenge, as we talked about yesterday. See, how to invest right now. There's a large contingent of individuals that are going, I don't want to buy right now. The markets are overvalued. They're extended. They're just kind of crazy speculative bubble going on in the markets. And those are all true statements, but you have to invest anyway. And that's the hard part about investing, is that sometimes you have to buy markets when they're in bull markets, because they're going to keep going up for a while. That's the hard part. That's the challenge. I can sit out of it. I can sit out of the markets right now and be okay, right? I'm too concerned about losing my capital. I get that. I'm concerned about losing capital too. Nobody likes losing capital. And I can certainly sit out of the markets, and this market can continue running without me, and I'm okay. I haven't lost any capital. That's called loss avoidance. That's a psychological behavior. I have to understand that I need to run the race. I have to participate in the market, but be aware, and this is the challenge, but this is also the mistake that investors make in markets. They assume that tomorrow we're going to wake up and the markets are going to be down 50% in a day, and I've lost all my capital. Markets don't work that way. That's never going to happen to you. I can invest today with relative safety, even though markets are overvalued, even though markets are extended, because there is a bullish bias and there is a push of liquidity that is coming into the markets right now from everywhere. Global central banks are cutting rates. We are seeing massive floods of liquidity into asset prices from private equity. Do you know, here's a little stat for you this morning. Do you know that there are more private equity companies than there are McDonald's locations? There are 19,000 private equity companies fueling the market. There's only like 14,000 McDonald's. So they all have to invest that capital. If I'm a private equity company and I have capital to invest, I have to invest it into something. I have to buy something. Otherwise, I have to return the capital to the investor. Liquidity is key. Everything is driven by liquidity. understand that liquidity flow is very, very large right now. And that's going to continue to push prices higher at the moment. So I have to participate with that. At some point, we're going to start seeing deterioration in those. I was just having an email conversation with a friend of mine, Albert Edwards, over at SocGen. And, we were talking about, the ebbs and flows of markets and the insanity in markets. And those things will change, right? And things like MACDs and relative strength indicators, those type of things are certainly going to tell you when those things are changing. And it'll give you plenty of time to take profits, reduce risk in markets, et cetera. You're not going to wake up one day and be down 50%. You're going to wake up one day and be down 2 or 3%. And if you choose to do nothing, the next day you're going to be down 2 or 3% more. If you choose to do nothing, the next day you're going to be down some more. But see, that becomes a you problem. Actually, it's all a you problem. It's psychology all across the board. On the way up, loss avoidance. I'm not participating because I'm afraid of losing money. On the way down, I get myself trapped in this psychological recovery idea, which is that, well, as soon as it gets back to where it was, I'll sell and get out of the markets. But then you don't, and markets just keep going down. So we get ourselves trapped in these psychological cycles, and that keeps us from investing. So where's the best place to invest right now? The markets. If you like gold, buy gold. It's going up. If you like Bitcoin, buy Bitcoin. It's going up. It won't one day, but for now it is. Buy stocks. Buy things with fundamentals, you're going to be better off. Things that have revenue, cash flow, those type of things. So if you're looking at an asset and it doesn't have revenue or cash flows, that you have higher risk there because you're solely dependent on the buy and sell demand for that particular asset. Right? So as long as there's more buyers than sellers, gold prices are going to go up. But there's no underlying fundamental basis in gold prices, just commodity. If I buy a company, Apple, Microsoft, Google, whatever, I've got revenues, I've got cash flows, I've got assets, I've got all kinds of other things that go along with that other than just price demand. But at the end of the day, don't forget that it is the number of buyers versus the number of sellers that move price in any direction. It is always about buying and selling demand within the markets. And so as long as the buyers outweigh your sellers, prices are going to go higher. When that changes, that's where the problem comes. And that's why you want to pay attention to things like investor sentiment. You want to pay attention to buying and selling demand. You want to pay attention to volume indicators. Those tell you, those are your indicators. Those are your breadcrumbs to understanding when this market's going to ultimately change. Okay. Interesting comment in chat right now. Donald says, I don't mind a 5 or 10% down, don't like a 20% down. You will mind a 5 or 10% down. It's easy to say that. People say that all the time, but I will guarantee you, because this market has been so complacent and such low volatility at this point, that a 5 or 10% drawdown is going to feel like a 20% drawdown. I see this all the time. We navigate markets very well in our shop. We have minimal drawdowns in accounts when they occur. Let's just talk about, the April drawdown. Markets were down 20% in April. Our portfolios were down about 5%. And we had people panicking. Oh my gosh, I'm down 5%. I got to get out of this market. I can't stand it. Psychology. In a very low volatility environment like we have currently, where market moves are less than 1% on a daily basis, a 5 or 10% drawdown over the course of a week is going to feel like a 20% drawdown. So it's easy to say, I don't mind a 5 or 10% drawdown, but even a 5 to 10% drawdown will elicit emotional responses that lead to bad investment decisions. Again, percentages matter. We just had this conversation on Monday talking about the illusion of percentages in markets. A 5 to 10% drawdown right now is a significant drop. To get back to April lows, which is not that far away in terms of the market, would be almost a 27% drop. The deviations to get back to the 200-day moving average are getting fairly significant right now. So these are all the things that you want to pay attention to, right? 670 points on the S&P, a 10% drop, is going to feel like a lot. So, all right, I'm going to kind of scroll through some of the chat here and see if there's any questions that we can comment on. Okay, got you one. Thank you. You're going to do that for me? I will. Okay, perfect. Brent's going to try to scroll through your commentary and pick out good questions for you this morning. So I had a question. What's the number one thing on your mind about the markets right now? It's liquidity flows. That's the biggest concern I have at the moment about the markets, because right now liquidity flows are very robust. The question is where is all that liquidity coming from and how long can it last? And again, this is what drives markets on any given day is liquidity flows. So as long as liquidity is flush, which it is right now, and amazingly so, that's the thing I'm watching most closely. Now, the Fed's cutting rates. We've got central banks globally cutting rates 88 times this year so far. But here's the problem with that. While the central banks are slashing rates and driving liquidity, at the same time they're doing that, they're also expecting stronger economic growth next year and higher rates of inflation. But we just had a conversation yesterday with Daniel LaCalle, who we're going to have an interview with him on Monday on our interview series. I highly suggest you watch it. Portfolio manager, understands world economics, etc. And we have a very deep discussion covering everything. We cover cryptocurrencies, we cover gold, we cover all kinds of stuff. And but the bottom line of this is that while there's a lot of concern about inflationary pushes right now, the very actions of what's happening globally within central banks and governments is very disinflationary in nature. It's very hard to have an economic resurgence in a disinflationary environment. Those two just don't live together. But yet everything that governments are doing are disinflationary and have an impact on earnings growth and corporate profitability in the future. So there's a lot of dependency right now. So the number one thing I'm, kind of watching is liquidity, but also there is a lot of expectation built around this whole AI trade that we're going to have this resurgence of economic activity next year to pick up on earnings growth and to make sure that earnings growth can justify current valuations. So again, when we all come back at the end of the day, you remember one thing about markets is that as an investor, all I'm doing is saying I'm willing to pay $100 a share for this company based on its current earnings. And its current valuation is 22 times earnings based on, I'm just picking a number, 22 times earnings based on what it's currently earning. But my expectation is that those earnings are going to increase by X by next year or the year after. Therefore, I can pay more for the company today. In other words, I can pay 24 times earnings for that company today because earnings will grow into that valuation over the next year or two, right? That's why valuations go up. So sentiment drives valuations. I'm willing to pay. My sentiment says I'm bullish on markets. I'm bullish on this stock. I'm bullish on whatever the asset is, right? I'm bullish on gold, whatever. I'm willing to pay more for that today because I expect X to happen in the future. The problem that we get ourselves into, and this is the big concern, is that in a slowing economic environment that is disinflationary, that is not going to justify the current valuations that are being paid in markets. That's the risk. That's the thing that I worry about right now. Is a re-estimation or a revaluation of those expectations, because those expectations are very, very elevated right now. And this is something that we've talked about before on the show. And here, let me show you this chart. This is a contribution of earnings by sector group. Now, it's a little bit convoluted, but the black line is the one you want to pay attention to, right? So the black line is the S&P earnings growth. The green line right below it, that's mega cap and tech stock earnings. Everything near zero is everything else. That's cyclicals, energy and materials, and defensives. So what this is showing you is that outside of mega cap, tech, and growth, as my dad would always say, ain't nobody doing nothing in terms of earnings contribution. And this is why, so go the next chart here. So this is the year, but this is what Wall Street expects. So that's what's happening, right? Mega cap tech growth is generating 80 to 90% of all the earnings right now. However, going into next year, Wall Street expects that mega cap tech earnings of Mag 7's earnings growth is going to slow rather sharply next year. And magically, the bottom 493, who ain't doing nothing around here right now, are going to start doing something. But that's going to happen, in theory, in a resurging economic environment. But think about this for a second. Let's go back to 2022, 2023, 2024. Economic growth was booming in 2024. And the bottom 493 did nothing. Earnings growth is doing pretty, economic growth is doing pretty good in 2025 outside of quarter one because of that tariff issue. But second quarter, third quarter, rolling right along here, near 3% growth, and they ain't doing nothing here. But magically, this earnings resurgence is going to occur next year amid an environment of slower economic growth and disinflationary pressures. That's the risk. That's the thing that's got me going on, that I'm focusing on. So, you know, these are the points that we've got to focus on. And again, it all comes down to economics and fundamentals. The problem with the markets right now in the short term, and this is what we're dealing with at the moment, is narratives. Pick an asset class, there's a narrative to go on with it, right? Stocks are doing great because of AI. Everything's AI. Emerging markets, international, doing great because their valuations are cheaper than the U.S. That makes no sense whatsoever, by the way. Because economic growth in Europe is going to be around 1% next year. We're going to be at 2%. Neither one of those are great, but Europe is worse by half. But there's a narrative. These narratives are just a function of rationalization of price. As price goes up, I have to rationalize why the price is going up, so I'll come up with a good narrative. And that's what's going on. The risk to that, of course, is the reality when it shows up and undermines that narrative. And this is why we talk a lot about narratives. We talk a lot about, you know, the issue with narratives, and this is why we focus a lot on looking at technical analysis in particular, because without some type of structure to understand price dynamics, you start following a faulty narrative. And narratives are fine in the short term, right? Completely okay. But narratives lack fundamentals. So we've got to focus on those two things that kind of matter the most as we start to look forward. So, kind of the other thing that, and again, so I'm you know, kind of as we're just kind of talking through this, one of the other things that, you know, is worth noting is that the economic data, which we're lacking right now because of the government shutdown, is not changing dramatically. Now there's some other like for instance, like the employment report as a good example. So markets were all, kind of flustered. I was like, oh my gosh, media headlines were, oh my gosh, we don't have an employment report. What are we gonna do? We're flying blind in the markets. No, we're not. There's plenty of other data out there. And it doesn't take a lot to go look at other data in the marketplace to figure out kind of what the BLS report would be telling us. And what we know is that most likely in September, we created about 50,000 jobs. Now, that was not negative, but 50,000 jobs is not booming employment growth. Now, the hope is that's going to start getting better. We're going to start hiring more and more people. But it's not terrible. And again, markets quickly adapt to the lack of economic information when they occur. So this is what we have to do as investors, is to start looking through and saying, look, I'm lacking this piece of information, right? There's other information I can get, and I can approximate some of these other things. But this is the problem we get into as investors, is that we start to kind of become lazy in terms of our processes. And we start ignoring data. It's like, oh, the markets are going up, so it really doesn't matter. These things matter, and they will matter down the road, because again, it's all, at the end of the day, it's all fundamentals. I've got to know, as an investor, I need to know where employment's going, because why is employment so important? Because that's where the money comes from for people to spend. If they don't have jobs and they don't have money, they can't spend money, which creates economic activity. Economic activity is where earnings come from. So if I'm paying 24 times forward earnings, or if I'm paying 40 times trailing CAPE, whatever value, 200 times, 2 times market cap to GDP, the Buffett indicator, whatever valuation measure you want to use, I don't care, right? But they're all elevated, which suggests that we're all banking on a massive economic recovery to bail out that overvaluation. We need GDP to catch up with market cap to justify the Buffett indicator. That's what we're banking on. That's what investors are betting on right now, is they are betting on an economic resurgence to catch up with overvaluation. So that's why it's important to pay attention to the economic data, because at the end of the day, consumers, 70%-ish, 68% of the economy, if they're not spending money, doesn't matter. But Lance, it's all about AI. I get the AI story. Think about it this way. Tesla's going to build robots. So we're going to have robots everywhere, right? We're not going to have maids anymore. We'll have a robot in the house that does the maid work. Right? Won't have a lawn guy, because we'll have a robot that mows the lawn. Won't have to have a car wash, because we'll have a robot that washes the car. You get the idea, right? I mean, in theory, we can replace the vast majority of human labor with robots at some point. A lot of people are running around going, yeah, but I'm an electrician. Robots can't do electrician work. Tesla's going, watch me, hold my beer, right? Robots can do anything that they're trained to do. They can do it faster. They can do it more efficient. They can do it with lower cost, so forth and so on, right? Nobody is safe from this. But if robots replace all the work, yes, it makes companies a lot more profitable, right? If I don't have any employees, if I just have AI doing all the work in my shop, I can be hugely profitable, because all I got to do is just pay me. But where are my customers going to come from? Robots aren't going to be my customers. They don't get paid. Who's going to pay? Who's going to come buy my product if they don't have jobs? Right? If they don't have income. So this is the process that markets have got to come to grip with. And the expectation is this huge increase in productivity for companies is going to create this massive surge in earnings profitability. That's a true statement. Productivity increases have been a huge boost since 2000 because of the internet. The internet has vastly increased productivity for companies, which has increased their profit margins. But at the end of the day, they have to have customers. And we don't have this all worked out yet. There's just this huge bet on this booming profitability for companies, but nobody's looking forward going, okay, yeah, but where's the revenue going to come from? And that's when we have to pay attention to a lot of these things. So Jeff makes comment in our chat saying having employees drove me to become a trader. Yeah, I get it. Employees are not fun, right? And they're expensive. And this is why there's a big push to eliminate as much employment as possible, because they're the single most expensive cost to any business, which is employment. And, it's interesting because you'll hear people say, well, they only, it only costs you $60,000 a year to have somebody. That's not a true statement, right? Because I have to hire them, then I have to train them. I have to give them a space to work in. So I've got rent, I've got equipment, I've got overhead costs. I've got to pay benefits, got to pay Social Security, FICA, FUTA, all that other type of stuff. So when you think about a $60,000 a year salary employee, their actual cost is much higher than that because of all the other stuff that goes into it. And of course, the high, that's just kind of the average right now. But, if the higher the job, the more cost there is. So that's the single biggest, employment and taxes. Those are the two single biggest impacts on businesses. So anything I can do to reduce that employment structure, the more profitable my business will be. But the problem is that, again, the very person I laid off is my customer. And if we do this shift, and again, and this is why, lately I've been posting charts looking at full-time employment relative to the working population, not the working age population, not just people available to work. I'm talking about just looking at the population of people that are working, right? How many of those are full-time? A, that's declining, and B, that's already at some of the lowest levels we've had going back to the 70s. We're just and that every time we go through one of these cycles, whether it was the dot-com cycle or whether it was the financial crisis, every time we recover from these economic downturns that occur, companies are coming back more efficient. And as they come back more efficiently, they don't hire as many full-time employees. They figure out how to, we had this many employees before the financial crisis, so when we come back now, we're going to be a little bit leaner this time around, and we're going to replace these people over here with technology or productive systems or a better way to do it, whatever it is that requires less employees. So we recover. Every time we have one of these economic downturns, we do recover in terms of employment. Think about the pandemic. Shut down the economy, send everybody home. Massive surge in employment coming back. We weren't hiring new people. We weren't putting people to work for the first time. We were just hiring back everybody we laid off because of the pandemic. But we didn't hire back as many people as we terminated on a full-time basis. There is a very high, and why is that important? Is because there's a very high correlation between full-time employment as a percentage of the total working population and economic growth. And that shouldn't be surprising. So just some things to think about. I've got a couple articles coming out this week. I've got one coming out this week talking about corporate profitability. next week, we're going to talk about this thesis of an economic resurgence, how likely that is to be. So again, we've got some stuff coming up that's going to further kind of address kind of these comments and things that we're talking about this morning. But coming back to all of this is that all these narratives that are going on right now, they're fine. There's nothing wrong with them. The markets are very bullish. Markets are going to open up this morning. NASDAQ's going to be up about 34 points. Bitcoin's going to be up a little bit this morning. So everything that got sold off yesterday is going to, kind of bounce back today. And that's not surprising. That's the nature of the market right now. Every little dip is being bought. So as soon as it pulls back, it's like, oh, there's my entry point. Got to get in. One day, we're going to have a down day. The next day will be a bigger down day. The next day after that will be a bigger down day that takes out important support. And then it will start to cascade at that point. Now, again, you're going to have some up days in there along the way, right? But you're going to start to see a shift in market sentiment. And when you see that beginning of that shift in market sentiment and begin to see the breakdown of the technical indicators in the market, that's going to be your indication to start becoming much more defensive. That's not today. But that will come. Maybe not until next year. But it will happen. And it'll be for some unknown reason. For some reason, the dollar's surging. Why? Who knows? For some reason, markets just decided that they're taking profits. It's like there's some group out there on Wall Street and some guy goes, all right, that's it, I'm out. Kind of like in Trading Places with Eddie Murphy. I know y'all are probably too young to remember that movie, but all on the trading floor, and then all of a sudden it's like, I'm out, and everybody's just like crazy, got to sell all at the same time. And that's just the way markets work. And so, again, it's not going to happen all at one day. This fear of I'm going to wake up one morning and lose all my money, that's not going to happen. That's not a rational fear. Understanding that the markets are going to eventually correct, the understanding that there's eventually going to be losses in the markets eventually when it occurs, it's navigable. We can navigate those. We don't have to worry about it today. We don't have to worry about it tomorrow. If you've got money to invest today, invest some money today. It will change, but not today. So, don't let irrational fears drive your investing mentality. Trade the market you have, understand the risk that you have in the markets, and navigate it. And you'll be okay. All right, that wraps up the show for the day. Appreciate it very much. We'll be back tomorrow with Think Tank with Michael Leibowitz. And, of course, as always, get by the website, realinvestmentadvice.com. Your questions, comments, etc., always very helpful. Always enjoy talking about those things with you as well. So like and subscribe to the channel. Helps us a lot. Also, get by the website. Our latest blog posts are out. A good piece on Friday, and this weekend's newsletter will talk about the market melt-up. So a lot of stuff coming for you all on the website, realinvestmentadvice.com. Have a great day.